Where'd you get the mug?
Mika bought it for me. And the kids.
And that's why we're gonna fit.
And then after writing Jay's mug, do not touch, someone fucking touched.
That's the new one says.
No, it's ridiculous. We good?
Yeah.
Ladies and gentlemen, Jay McInnes, Sharp Real Estate Group, episode 281. Today we are discussing title, Why Do the Benchmark Housing Prices Keep Going Up? Now we talked about this last week a little bit. We touched on it. I'm gonna dive into a little bit more detail on what that has looked like, why it's happening, and why, again, it just, I mean, everyone out there trying to pick tops and bottoms and play the game, gamble it out, it doesn't make sense. You just got to get in when you can afford to get in, no sooner, no later. So here we go. As we touched on last week, the benchmarks are all up. So a little example, detached, we're just going to focus west side, detached townhomes and condos, the three segments that we have here. So the detached benchmark price for April 2024, as we discussed last week, is $3,527,900. That benchmark is up over 1 month, 2.2%, 6 months, 2.7%, 1 year, 6.2%, 3 years, 4.2%, a little wavy in the middle there, as we've had some interesting years past. And the 5 year is up 20.4%. Now, that's $597,000 in 5 years. So if you had waited 5 years to buy a detached house on the west side, of course this is benchmark, this is average, it has cost you $597 extra $1,000 today, as opposed to 5 years ago. Funny thing about that is the 5 years before that was up another 27.7%. So you're looking at over 50% in the last 10 years for West Side detached. So again, the more data that you accumulate, the more you look into it. I know we like to headline read and run through all the media stuff that's going on now, affordability and housing crisis and all this sort of stuff, but just looking at the numbers, it really doesn't make sense to wait if you are lucky enough to be in that position. Townhomes benchmark April 2024 is 1.525 million. Again, 1 month benchmark increase, 2.8%, 6 month, 3, 1 year, 1.5, 3 year, 13.2, and 5 year benchmark increase of 30%. So that's $350,000 had you have waited. Just off the top in itself, that's the leverage you have lost. The 5 years before that, another 52.6% increase. So year over year over year, as all the stuff we're doing is happening, you really need to take into consideration the numbers continue to push on. And even though we've had, I'd even go as far as to say, a tumultuous handful of years in the market, it is still dramatically up. And we're gonna dive into why that is shortly. And then condos, of course, benchmark is $855,000 for April. 1 month benchmark negative 0.1. That's the only negative we've got on here. 6 months, 0.5 increased. 1 year, 1.9, 3 year, 6.9, and 5 year, 16.2. So have you just waited those 5 years for that perfect condo to come up, you would have lost $119,000 of buying power just off of this increase. The 5 years before that, so that's 2014 to 2019, 61.3% increase. So it just does not make sense to wait if you don't have to. So what is at play here? So there's a few things making up the strength of real estate. There's a few things making up the weakness of real estate. We're just going to compare those briefly here. So the market in itself, of course, population growth, something that's been extremely hot topic over the last handful of years. So not overly simplified ways to get the exact data we're looking for, but as far as I can find, StatsCan and all this other stuff, 2019 to 2024, so just before COVID, just making that perfect 5 year rounded conversation. Vancouver in itself, Vancouver proper, you may call it, has had a population increase of roughly 6.29%, which is 147,000 people. So are all those people the rich immigrants that leave all the houses vacant and all that. Some of them are all those people, the poor people that are here and apparently complaining they can't afford to live here, so they're moving out again, some of them. But there's all those people also in between. And a lot of those people are gonna come here, put their kids in school, and buy real estate. So that's 147,000 people. Let's just say we cut that in half because couples are coming and all that fun stuff to be economic. So what's that? 70 something thousand people need a place to stay. So I'm not going to talk on the rental market today too much, but of course a lot of those people may rent for the first 12 months with assumptions to then purchase once they get their feet on the ground and settled. So you've got that sort of pressure coming up, pushing prices up, obviously, as there's more demand coming in. Business growth, 20 to 2024, this is a very vague estimate that I got. Again, very difficult to find. You're extrapolating out of provincial growth, but estimated there are 100 to 150,000 new private sector jobs based in Vancouver from new or expanding businesses. Again, estimated off the provincial numbers. So Amazon, for example, prime example just down the street, when new jobs come in, new corporations like that at said levels, you've got new high-paying jobs with new money entering the system, and of course, new high-paid employees here that want to buy real estate. So as that business case grows and those new people come in, of course, more pressure on pricing. Generational wealth transfers, money transferring parents to kids. Never to forget what we've discussed before, that 50% apparently of Vancouver homeowners are mortgage-less. So there's a lot of equity there, giving flexibility to give those trust funds over early, give that inheritance over early in the form of down payments, deposits. So that is something that has been consistent for years and years from what I've seen on the ground as an agent, of course. At all levels of purchase, really, from the entry-level first-time home buyer to the extremely luxury kind of 5 million plus buyers, you're getting money movement within families. So that is another very big reason why pressure is constantly, can't get comfortable here, oh Jesus, these chairs. Pressure is constantly on the market from that standpoint, from locals. We'll use as this example at all price points of the market, at all levels. And then of course, you can call it manipulation, you can call it cheap interest rates, whatever you want to do. Cheap interest rates that we've had over the last 5 years, half of the last 5 years, of course. 2019, you could get a fixed rate for 2.95. That's what I got. February, what are we doing here? By February 2022, you could get it 5-year fix of roughly 199. You can get them less depending on the broker and all that sort of stuff. But that was kind of a big bank number. And then of course, March 2022, the rates started to increase. So the first half of that year, you had extreme, we'll call it stimulus in the form of cheap money. When the government makes money cheap, the people take it. So that's in mortgage rates, that's in lines of credit, that's on kind of all of those bigger picture non-credit card circumstances that, again, when the money gets cheaper, people can justify doing it. People can justify refinancing those homes to do the renovations, refinancing those homes to buy investment properties, boats, cars, whatever the hell they're gonna do. So those have been the main stimulus points that we're gonna say from the fundamentals that we've seen over the last handful of years. And in any market, we're only talking about Vancouver, of course, but in any market, it's going to experience these things depending on these different points. A lot of this, other than money transfer, is all, of course, government-led. So there's a lot of string pulling from the top. How do we want this to play out? Now the minuses, things that hurt the real estate market, high interest rates. So what we've seen from March 22 to today. Today you're roughly looking at 5% for a 5-year fixed mortgage. So dramatically different than what you were seeing before. So that, of course, well, I just can't afford it. There's a lot more mortgage stress tests, mortgage qualification process in place now to make it more difficult. So those strings can be pulled and pushed to have the systems easier accessible or harder to accessible, that money to borrow. But again, high rates, just generally speaking, has kept people from buying, has kept people from selling, and has kept people from pulling equity. So you've got a lot of freeze in the market from that. More market friction, so again, less flexibility of use. For example, the recent short-term rental market. No more Airbnb unless you follow these stringent points. So the government, again, locking things down and tightening things up. If I can't Airbnb it and get that sort of return, I'm not interested in putting a normal tenant in and getting a traditional return, so I'm not gonna buy that investment property, or maybe people try and sell that investment property. So that was a big one as of late. Taxation, another huge hindrance to the market in general. Vacancy tax, speculation tax, empty homes tax, property transfer tax, foreign buyers tax, flipping tax, school tax, capital gains tax, property tax, of course, GST on those new homes. So as you can see, of course, all a government layer, and the government year after year, it seems like sees more and more as the prices increase and increase, how much transfer of we'll say value is taking place here in the real estate market. As you know, taxation, the government gets involved when money moves. If you sit money in your investment account and it grows tax-free. The taxable event is when you pull the money out. When you purchase something at the store, that's a taxable event. The government puts its hands in. So anytime money moves, the government slithers in. So of course, real estate transactions, outside of the big boys doing all the whatever, corporate finance and what are those smart guys that do the big investment bankers and all that crap, when you're selling big multi-million-dollar corporations and all that sort of stuff, a lot fewer and far between than ye old real estate market that us normal people are dealing with every day. So when these prices get higher and higher, the government obviously looks into this and says, we can extract value from this. So there's a lot of movement going on in the real estate market, and as prices increase, so do the taxations on these percentages layered in. So they're not gonna let that go easily or ever, in my opinion. We can discuss at a later date them throttling access to new product against the popular narrative that new homes are getting built, which we also discussed on Vancouver missing targets last week. But the more expensive the real estate is, the more money the government can derive from said industry in the form of all taxes just discussed. So there's definitely incentive for prices to stay high for a variety of reasons, but specifically that one, as all these taxes run on a percentage scale every time a property moves. Now, that's the used stuff. Developer taxation. Of course, we've dug down into this over the last year. It's figured out that roughly 30% of the cost of any new piece of real estate is taxes and red tape. 300,000 on every million. So again, with developers, CACs, DCLs, ACCs, permit fees, utility fees, property transfer tax again, public art contributions naturally, and all their infrastructure and amenity needs then get layered on from the municipal or provincial layer into the real estate market, but via the developer. So when you see, again, all these fees layered on at the front for us on the taxation side, all these fees in acronyms and all that other taxation stuff, which is done a little bit more sneakily, where they attack the developers. And again, the market pays for that 30% off the top naturally. Everything gets passed forward to the buyer and or seller. You're seeing that, again, the attack on the industry from the government side, layering costs in and all that sort of stuff. So naturally, when costs increase, affordability decreases, and you're seeing that again on the things that are hurting the real estate market, just obscene layers of tax and red tape from both levels, at the front end and then obviously at the development side as well. And then the biggest thing, of course, as we scale this kind of microscope back on the market, is the really big important thing, why the real estate prices are staying as they are, and I believe will continue to see benchmark pricing increase as we have, as just discussed, is because it holds true that as the dollar is, what's the politically correct way I can say this? As the dollar is devalued away, we need to put our money into assets that are going to sustain value. Basically, you then see people, and a lot of people blame the boomers for holding all this real estate and being rich and being NIMBYs and all that sort of stuff. And that's fine, right place at the right time, whatever you want to call it. But what they have seen, if you've paid attention at all and have owned real estate or watched the economics take place over the last handfuls of years, is that the dollar is constantly being devalued, and you need to peg that against an asset that is going to increase as the currency devalues. So what are you going to put that into? Most would pick real estate. At least in Vancouver, that's an extremely popular asset class to select, to place money in. There's no point in holding the cash if day after day, slowly but surely, it becomes less valuable. So then you see the commoditization of real estate. What does that mean? I've pulled the ChatGPT example of that exact meaning for you here. Commoditized refers to the process by which goods and services become indistinguishable from similar products and are trading primarily based on price rather than unique features or quality. So obviously there's different types of real estate. There's homes, there's condos, there's good ones, there's bad ones. So it's not so literal in this sense. Reading on, when the product is commoditized, it loses its unique attribute and that might differentiate it from competitors, leading customers to view it as interchangeable with other similar products. So again, don't look so nuanced into that. Take one step back, and we're putting our money into the real estate market in the form of a house or in the form of a condo or a pre-sale or a house or a condo that we're just going to leave vacant, because if we put it into that asset, it is going to increase as the Canadian dollar decreases. We can't save in dollars, we have to save in something else. Some people will pick blue chip stocks, some people will pick gold and silver, commodities, Bitcoin be it, but right now, of course, we're discussing real estate, and that's why you've got a lot of this foreign money who are coming from other countries with devaluing currencies that have experienced probably a quicker devaluation, that know not to trust the government and the dollar, any of these fiat currencies. So you need to put it into hard, tangible things. And what better to put that into than real estate? So we're gonna dive into a little chart just to explain that a little bit further before we tie up here. So again, this 5-year window, 2019 to 2024, we've plugged the dollar into an inflation calculator. Oh, getting a little bit more technical as the months go on. So we get 2019 to 2024, that 5-year window, cumulative price change, we've lost 16.78% of the dollar's value. Meaning in 2019, what you could buy for $100 Canadian, now you need $116.78 to purchase. So the value of the bread, the value of the car, the value of the computer has not gone up. The value of the currency you're using to buy it has gone down. So that's that 5-year window. So as you can assume, again, we're not going to get into the compounding of real estate and the leverage. I think we all know we put a deposit down, we take a mortgage for the difference for the most part, and we're leveraging market fluctuations. Leverage is on the total price of the real estate, not just the price of the deposit. So now your 16.7% fluctuation means that your $1 million condo, you need to come up with an extra $167,000 of today's money to purchase it, as opposed to if you'd purchased it in 2019. So just the market value, the currency value alone has arguably brought that $1 million 2019 condo to $1,167,000. Before market fluctuation, before is it a buyer's market or a seller's market, before this has turned out to be a really popular building and there's no other 1 bedrooms or 2 bedrooms like this in the neighborhood, before all of that market stuff, The currency alone has brought the value of that real estate up because it takes that much more to buy it. And we can only buy it in our local Canadian currency, obviously. You want to buy it in US dollars, take it to the bank, exchange it to Canadian Bitcoin, exchange it. Sell your gold, always has to be transacted in Canada in Canadian dollars. Same thing you would experience in America, US dollars, Australia, Australian dollars. So you've got that churning against you in the meantime. Now, how much of that has brought the benchmark pricing up? Well, a lot of it, because again, the benchmark prices are all derived in Canadian dollars, which is exposed to this inflation. So a lot of people have only heard about, unless you've researched it or looked into it or have experienced it and you're older over the years, only heard about inflation since as of late, because Putin's created inflation and the directors of all the grocery stores have upped prices and they're bad, they're creating inflation. It's not that, it's the money that has been poured into the system without the productivity eating it up that has brought the value of the dollar down and in turn put the price of the food up. For example, a loaf of bread is $2. We're selling out, it takes a week to sell out. Now it takes 5 days to sell it out, 4 days to sell it out. Well, we better put it up to $1.25 because there's enough money out there that people can absorb that. $1.25, 5 days to sell out, 4 days to sell out, 3 days, $1.50. And then you can see how the trend goes. So that trend follows back down the whole chain, the whole supply chain, which was another big key tag word in COVID and all that. So we're not gonna get into that any further, but I hope that paints the picture. So to paint the final picture here, just for a bit of fun, let's go back. If you can believe it or not, I was born in 1981 now. I know, it's unbelievable. Time flies. So since my birth, just to paint a bigger picture, you need, and we'll put the charts up here on the screen, but your cumulative change is 220%, 0.65. So $100 in 1981, to buy the same equivalent today, you need $320.65. So again, I assume that picture has been painted. Again, this is all government manipulation. Inflation doesn't have to happen. They have printing schedules of currency and. So like all the taxation, which is very deliberate and chosen, this is also very deliberate and chosen. You can jump into the online and find charts dating back to the early 1900s of what inflation has looked like. Yes, it is more tame outside of the COVID years now than it was in the past. But the point of all this is that there's a lot of things pushing and pulling the real estate market. 9 out of 10 of them are government influenced. So looking at the numbers will just paint a little bit better picture of what's going on than just watching the news or reading the headlines. Ow, time. That's it. I will see you in 7 days.